Well, good morning, everyone. It's wonderful to see you all here at NABS 2024 today. As mentioned, my name is Tim Savage, and I'm a tax partner at Weaver and run the firm's digital assets practice. It's my pleasure to serve as moderator for the next 30 minutes or so. So we'll be covering legal, accounting, and tax considerations surrounding the digital assets industry. I sure hope you've had some coffee. I know you can't bring it in here, but it's sure to be a riveting discussion.
Everyone's favorite topic.
Oh, yes. Oh, yes. Joining me on stage are two distinguished panelists, Joshua Smeltzer and Aaron Jacob, both of whom are highly involved in the industry. So let's jump right into some quick introductions. Joshua?
All right, sure. Joshua Smeltzer. I am a tax litigator at Gray Reed. I run our tax litigation practice there, and I'm also a co-chair of our digital asset practice as well. It ended up as a nice extension. We co-chair that with my partner in the SEC. If you got a problem, it's usually the IRS, DOJ, or SEC, and we cover all three of those.
Awesome. Thanks, Josh. And congratulations, Tim. It's awesome to be here with you. Great to be here with everybody. Yeah, round of applause. I'm Aaron Jacob. It's a pleasure to be here. I lead TaxBit's enterprise accounting solution business line. I'm a CPA, have been a CPA for a long time. In a former life, I worked at the Financial Accounting Standards Board. We'll dig into a little bit of what they're doing there. And this is the nonprofit SEC-sanctioned group that is designated authority to set U.S. GAAP. So kind of an important body in our world today. And at TaxBit, we support companies in their compliance needs. Companies that are dealing with tracking and following and staying up to date with an ever-evolving tax landscape, in addition to a financial reporting landscape. So if I'm filing financial statements, if I'm going through an audit, what are the rules that I need to follow, in addition to filing my corporate tax returns. And if I'm a broker, making sure that I'm following what the Treasury new regs are. So we'll talk about all that stuff.
Well, that's a great segue into our first question. So we'll dive into the accounting rules first. And there's been a lot of movement just among all of our regulators, not just the FASB, but specific to the FASB, which is the Financial Accounting Standards Board. Aaron, in late 2023, almost a year ago, the FASB issued a new kind of groundbreaking accounting standard regarding fair value accounting for digital assets. Can you explain what that is and how that impacts the industry?
Yes, this is something that the industry, frankly, has waited for a long time. This is a hugely positive change in the right direction. So let me just paint a picture of what the old accounting used to require companies to do. I'm sure some of you are intimately familiar and still have nightmares about this. And then what the new accounting requires companies to do and how that is so much better. Let's just say, for example, I acquired Bitcoin when it was at $50,000. I put that Bitcoin on my balance sheet at its acquisition cost, and I hold it at its acquisition cost essentially indefinitely, unless there is what we call an impairment event that occurs. So if the price of Bitcoin were to decline, I have to recognize an impairment expense through my income statement, so it's going to impact my bottom line. I write the asset down to its lowest point since I acquired it. So if I acquire at 50, I write it down to 15, I've got a big expense that I've got to take through my income statement, and then it sits at 15 indefinitely until I dispose of that asset. So sitting where prices are today, you can see how there's a giant mismatch between what accounting is reflecting on the face of the balance sheet and through the income statement and what is economically happening with the business. And for all intents and purposes, the purpose of accounting is to be an accurate reflection of the economics of an underlying business. So to users of financial statements that are making their own capital allocation decisions, that's not very helpful. And so the market started, bringing this up. The FASB started hearing this. There was kind of a groundswell. And thanks to leaders in the space, Michael Saylor has been a huge proponent of this. We were able to get that added to the FASB's technical agenda. They went through a diligence process, which, frankly stands in stark contrast to what we've seen with the SEC, kind of this regulation by enforcement model. The FASB actually listened to stakeholder feedback and said, okay, this is a problem. We can see how that's confusing to users of financial statements. And so they were able to change that. So what does the accounting standard require today that was issued last December, like you said, Tim? Well, today, companies are allowed to hold digital assets, hold Bitcoin, hold crypto assets that meet the scope criteria on their balance sheet at fair value. So if I acquire at 50, I write down, I still am going to take that difference through my income statement. I'm still going to reflect it at its then fair value on my balance sheet. But then as prices tick back up, I get a corresponding gain flowing through my income statement. And I'm representing the real economics of the underlying assets. So that is the headline change, that accounting will reflect these assets on the balance sheet at fair value with any changes in fair value going through earnings. This has just been wildly, positively received in the industry. People are embracing this, and we're excited to see, what it does for the industry going forward. I think it's really fascinating when you think about what are the barriers to entry that large enterprises have faced historically. We have the opportunity to work with, large sophisticated companies that are in this space. Fidelity is a perfect example from the last panel. What are the barriers to entry that companies face? One of those is I have to make sure that all of my compliance boxes are checked. Most boards, stakeholders, the decision makers at an organization, they won't approve bringing Bitcoin onto the balance sheet unless you can check the tax box, check the accounting box, the compliance box, the controls box. All of these parties and stakeholders need to be aligned. And when you remove a huge accounting headache, all of a sudden you've removed a barrier to entry.
Yeah, to reiterate, very positive change for the industry. It does come with some asterisks, especially if you're a miner. These fair value rules don't necessarily apply to your ASICs. You still have to, go into the impairment rules for those, which it's a lot more complicated. How do you value an ASIC for accounting purposes is much different than just simply what the market's trading at. So positive change, but still there's more room to go, more work to be done. But it's great that the FASB is opening up to the industry and being able to implement these changes. So one quick other question, Aaron, on that note. So when will this standard become effective, and what should companies do to prepare?
So when the board issued the guidance last December, they made it available for immediate adoption. So ever since the end of last year, companies have been adopting this guidance. And you actually have some publicly traded mining companies out there, many of them we work with, who have already adopted this. So you can go, you can see the face of their financial statements, you can see their disclosures, you can see their holdings represented at fair value. That was a huge boost for them over the course of this year as prices were ticking up. So for companies that haven't yet adopted, it's mandatory to adopt for your fiscal period starting after December 15th this year. So we're right at the doorstep of this being required for companies. So if you haven't yet adopted, it's something for you to think about and make sure you are ready for it, because it will be required. Auditors will, require you to follow this new guidance. So your question, what do they need to do to prepare? I think there's a couple of things. The first thing that I would start with is understand the scope of the new guidance. Not all assets, to your point on ASIC miners, not all assets fit within the scope of this guidance. If you hold Bitcoin, it's well within the scope of the guidance. If you hold major market crypto assets, it's very likely going to be within the scope of the guidance. But make sure that you understand that. I think the second thing is just prepare for transition. When you migrate from an old accounting standard to a new accounting standard, You need to make sure that you understand how does that migration work, right? Who are the key stakeholders that I need to bring along for the journey? This could include internal and external stakeholders. Think of your external auditor, making sure that you're ready for that. And then the last thing I'd say is there is just an operational element to adopting any new guidance. And you want to make sure that you have the processes in place, the tools in place, the systems in place to make sure that you can comfortably and efficiently follow the requirements of the new guidance. So we move to a fair value model. That's the headline, that's good news. I think that feels much more comfortable to folks. And in some ways it's simpler, but the devil's always in the details. So there are some complicating factors for this new guidance. One is that for the first time ever, companies have disclosure requirements. Those didn't exist previously. So there are a handful of disclosures that companies need to be prepared to provide to users of financial statements. And then, do you have a process to enable you to do the journal entries correctly, given the scope? So there's a lot to prepare for. You know, the time is now. We're right at the doorstep. It's mandatory for essentially your next fiscal year. But you know, there's still a little bit of time. So happy to chat with folks more about that if helpful.
Okay, well, shifting over more to the legal side of things, Joshua, there's been a lot of movement beyond just the FASB. You're deeply familiar with a lot of different regulators such as the DOJ, the IRS, the SEC. How do you think they will approach digital assets going forward, especially considering the recent election and potential Congress movement?
Yeah. I think the first exciting thing that happened in the regulatory sphere happened in June. I remember I was sitting at a tax conference, and two things happened while I was sitting there. The first thing that happened is the IRS official announced that in an hour, the final regulations for broker reporting were going to drop. And everyone pulled out their phone and started getting ready to see those. The second thing that happened was that the Supreme Court overturned the longtime precedent of Chevron deference for government agencies. Both of those things happened at that exact same conference on the exact same day that I was there. And that is important because I really think for the industry, what you have as kind of barriers to growth and barriers to adoption are the regulatory environment. Because I spent the first part of my career at the Department of Justice, and everyone recognizes that enforcement is necessary. There's still too much fraud out there. But if it's not done properly, the lines aren't drawn properly, you end up with two really negative effects. The first is restriction, because when in doubt, people are going to not do something that they think might get them in trouble, especially with one of the three-lettered agencies doing things like that. The second bad thing that happens is capital doesn't come into the market for digital asset communities. Investors, when there is uncertainty over the regulatory scheme, they will sit on their hands. And I think a lot more money would be funneling in to the digital asset community if we had clearer regulatory lines for that, because they would be more comfortable in giving that money. I think tokenization would be further along. A lot of other things would be further along had we not had that. So that development was the first, I think, step in letting us know that the legal atmosphere was going to be way better for the digital asset community. And then, of course, the most important thing for that is to have the right elected officials in place. And I think this election definitely did that. It was overwhelmingly for one party. I think that was primarily an answer to the inflation problem, which digital assets themselves have a certain amount of ethos to solving that. But what it did was also get more pro-crypto people who are involved, because eventually the rules will need to still be written. The Loper Bright is important because for all agencies, they have lived in a world where they can legislate with the benefit of deference going to them, and pretty sizable. All you have to have is any ambiguity, and then you get what the agency says you get. And that has become somewhat untenable as a proposition. They did a survey, and the legislators anonymously agreed that they're a lot more aggressive with the regulations they write, knowing that they had Chevron deference out there. So the final regs that we got for broker reporting, those were done under an old system written by people who thought that maybe, and if they saw the writing on the wall, maybe they wrote them differently, but if not, they wrote them thinking in a different deference thing. In one line in there that I think is important to mention is that they said DeFi regs were coming. I think those will be written a lot more introspectively and judiciously because they know they don't have the benefit of that.
Well, and judging based on how the broker regulations were construed and how those came to be, I hope personally the DeFi regs get pushed off, because I don't think they're going to be written as well as what some might expect. But that's speculation. So,
yep.
Are there any current legal proceedings, any cases out there that set precedent that the industry should be looking at to follow?
Yes, definitely. So in the tax sphere, we have some old fights that are going on. One is the Jarrett case, and that's trying to challenge the definition of staking, how those rewards are paid, doing it under tax principles. The DOJ, when that case first came up, it was only $4,000, I think, to buy themselves out of a decision, and so they bought themselves out of a decision, and they just gave them their money back. They said it was going to come up every single year. The court said, yeah, we don't care, you've been given your money, you don't get a decision. So they filed another lawsuit. I don't know if that'll be different this time. I don't know if the DOJ will pay them twice. But that's one to watch, whether or not the definition of staking is going to be done in the courts. We have regulation and guidance from the IRS, and it'll be determined whether it's going to change. The other thing that I think is important to watch is, we're probably losing the current SEC, regulator, and I think this choke point is coming to somewhat of an end. But it's been interesting how the litigation has kind of switched from kind of an aggressive SEC just coming after everybody and you trying to defend yourself the best you can, to some affirmative steps by trade organizations like the TBC and other ones that have started to file amicus briefs in some of these suits, challenging where the lines have been drawn on SEC authority. I think that's important to watch as we go forward too. And should any DeFi regulations make it through, I think you'll see under Loper-Bright and a bunch of other ones, I think you'll see a challenge of that. And it'll be similar to the SEC litigation of saying, the government gets to enforce, but it only gets to enforce as much as the law says it can. And we have some people pushing back on where that line is. And I think that's important for the industry as well.
Well, you touched on the broker regulations, which is more certainly tax considering.
Yes.
Aaron, can you maybe explain a little bit more about, how new these were, what that process looked like, and what are some of the important changes of these broker regulations?
Yeah, there was a lot in those regulations that came out. For folks like Josh and our team, we spent days after that reading through these and digesting them and trying to kind of synthesize what had been included in there. But there's I think one really important change for corporate taxpayers. So the regs were largely focused on brokers and what are the 1099s that need to be filed to their end customers? There's a new form, the 1099-DA, that came out that brokers are now required to file both to the IRS and to end users. But I think there's a really important change for corporate taxpayers, for your corporate tax returns, and that was this, which is usually lost in the conversation. Historically, when corporates have tracked their realized gains and losses, there's a couple of key things that you need to keep track of. One is, what is my pooling methodology? So am I using a universal approach where I'm kind of saying all of my lots are in a universal inventory queue that I pull from when I calculate my realized gains and losses? That's one thing. Second is, what is the actual accounting methodology that I use? Do I use a FIFO approach, kind of a first in, first out approach, or some other allowable approach? And then the third thing is, what is the documentation that is required in order to support my policy position? Historically, a lot of companies have used a universal FIFO approach. So I have everything smashed together into a single inventory. Even if I have holdings across many different wallets, many different exchange accounts, many different custodial solutions, for gain-loss tax calculation purposes, they've kind of smashed it together into a single inventory, which was wildly used across the board, very common, and there was nothing wrong with it. So as part of these regs, the IRS and Treasury came out and said, we don't like that anymore. So companies are going to need to move from a universal approach to an account-based approach, where I've got to track inventory queues based on the wallet, based upon the exchange account, based upon my custodial account. So that gets a little bit more complicated for companies to do. There's a lot of finer details that we can talk about that, and I'll just put a plug. There is a CPE session tomorrow morning. It starts at 8:30, where we'll do a deeper dive into financial reporting and the tax reporting. So if that's of interest and important to you, please come join us. But it is really critical that companies realize, hey, even though these new regs have gotten a lot of attention, and most of the attention goes to the brokers, like that applies to Coinbase, it doesn't apply to me. That's largely true, but there is this wrinkle in there that applies to corporate taxpayers across the board that's really important to really wrap your arms around.
So, and really, that actually applies to all taxpayers, but it just so happens.
That's right.
Right.
Individuals as well.
Corporates are more likely to have multiple wallets. Let's talk about the reallocation exception and how this is a gift to the industry, a gift to taxpayers. Can you explain a little bit about what that is and what our window of time is for those reallocations? So
the new requirements go into effect January 1st. You have a period of time leading up to that where you can basically kind of get your stuff in order. So when Tim mentions a reallocation, let's say I've been using a universal approach historically. I've got this finite window of time where I can redo that. I can reallocate my cost basis, is what Tim's alluding to. So I can move from a universal approach to a by account, by wallet, by source approach, and I can allocate or reallocate my cost basis to those different inventory queues. There's nuances behind all of this, but I think the key thing is for folks to walk away saying there's something I need to look into, pay attention, make sure that I'm prepared for when that goes into effect on January 1 of 2025. So we're not that far away.
Yeah, and maybe just to paint a quick picture, let's say you've got an air gap cold card with some BTC on it that's your never ever touch. You've got a hot wallet on Coinbase, and then maybe you have a ledger or a Trezor stored somewhere and all BTC, but under that universal approach, as you make dispositions, if you sell what's on Coinbase, the old methodology would probably look back and say, what's on cold card could have been bought first, and even though I'm disposing of my Coinbase, I'm going to use basis from my cold card. And what these broker regulations are saying is, no, you can't do that. You have to contain it to that specific wallet. And between now and really January 1st, if you've been doing this universal approach, which we disagree with, go and fix that and apply some reasonable effort to do that. If you don't, it's not going to be good. If you do, we'll have some grace, right?
There's one other interesting thing. I just alluded to it earlier, but the documentation side of this is pretty important because historically, sometimes you just don't think about your taxes until it's tax season. And you come to that moment in time, you say, okay, well, what if I do this approach? What does my tax position look like? If I do that approach, what does my tax position look like? That's no longer allowed either. You have to kind of contemporaneous throughout the year as you're experiencing transactions, make those decisions in real time. So that's another important thing to keep aware of.
Very good. Well, last question, Joshua. Now that the election is over and we have, the dust is settled, on the legislative front, what do you expect that we might see over the next really term?
Yeah. So I think the first priority is going to be to try and get some of the tax law that's currently in place extended, because a lot of it sunsets in 2025. But I think after that, we're going to start seeing some legitimate legislation start making it through the federal as well. What we'd like to see is a de minimis standard for capital gains on being able to spend the money, because one of the other barriers for mass adoption of cryptocurrencies is the ability to be able to spend it somewhat freely. And this is not a novel concept. We already have this in the Internal Revenue Code for foreign currencies. There's a certain amount you can spend, and you don't have to worry about it. You don't have to track it kind of onerously like you are right now. For anything, for any amount. So hopefully something like that happens as well. I think a stablecoin bill, which has been mentioned by lots of other panelists on here, I think that's probably, it's already been pretty developed and gotten pretty far. So I think that's something that's able to be done even in the midst and with the priority being the extenders happening. On the state court front, right, January 14th is when everything kind of starts here for state legislative stuff. But we've already seen some hints of some things that are going to happen, and one of them is talking about energy and grid stability there. And so it's unfortunate, but I think you're going to have to again explain that Bitcoin miners are not the reason for any sort of thing on the grid. In fact, they're a benefit to it. In doing that, I think that is going to come up, and I would expect there to be some along those lines as well. But again, I think that where we are right now legally and legislatively is a good position. I think it really is, because I think the courts are starting to become more familiar with it. It's more mainstream, more understandable. Legislators it's moved up the priority list for a lot of the legislators as well, so they're going to be doing it. And I think we've proven that legislating by enforcement just doesn't work. It's just terrible because we shouldn't be having the courts do it, and we shouldn't be having the agencies be able to kind of cause these mass costs to companies in having to litigate the issues that should be being done through the government, through government agencies, meeting with industry people and coming up with reasonable rules.
So the conditions are ripe for positive change.
I think so.
Well, wonderful. Just one last closing remark is, you mentioned the de minimis standard. We've seen what that could look like with the Gillibrand-Lummis bill, and I'm a huge advocate for that. The store of value thesis is well defined and people understand it, but we really need to move to the medium of exchange and the unit of account thesis, and that is the way that we get around the burden of administration of having to actually go spend your sats and buy stuff. So, if you're sitting in the audience and you don't understand that, it's a very important change and one we should advocate for. And when it's written into tax law, we should make it inflation adjusted.
There you go.
Because, that number could very quickly become not applicable. So thank you both for your time, and let's please join me in closing out here.
Thank you.